Hi, I'm Joel Gilgard with Gilgard Analytics. Thank you for tuning in to part two of 2022 asset classes and economic indicators. Um, so, in part one, we went through the notes and the graphs, and now we're going to get into the nitty gritty of the analysis. And so, the way to look at this is you'll have the year, always column A, and you're going to have the various underlying economic indicators or asset classes. And so on top, uh, I beg your pardon, here you could have unadjusted, and at the bottom here you can have adjusted numbers. Then you'll also have some analysis, at the bottom here. But we're only doing this with the dollar adjusted. You'll have averages, you'll have the standard deviation, you'll have the max, the minimum, volatility, and if pertinent, you'll have the yearly return, and then the current value. So this is basically just the value. What was the change between this year and last year? Year return, right? So we will go back and we're going to start with the US dollar index. And so this is just a compilation of currency baskets or currencies in a basket vis-a-vis the US dollar. So it started out at 102 back in 1915. I believe it was 190, 195. So it's fallen quite a bit. What you have to keep in mind is that even if you think the dollar's gone down, it has. It's gone down less than other currencies. And so it hit 102 in 2016. At the end of this year, the dollar became very, very strong. So it's the strongest it's been past generation. The next indicator, number two, is the U.S. first class stamp. And this just looks at the various prices. Started out 34 years ago, it was 25 cents. And the last year it ended up at 63 cents. And so what I've done is we do the stamp smoothing the price. So for example here, 25 cents was the price for many years. This is obviously post hoc, but once we saw that the price here was 29, we sort of changed it for a year, so you didn't have a jump all of a sudden. And then here, the stamp adjusted, what you do is you take the price back in 1999 as the base year, and you flip it. So, for example, the way to read this is the price compared to 1989 is only worth 40 cents today. So basically a decline of 60%. And so why is this 41%? Well, because we're at the same time, looking at inflation, which is internal. The whole world has some, but this is a U.S.-centric perspective, right? We're at the same time looking at assets, from a global perspective. How did the dollar do vis-a-vis the others, right? So you had many years, like 2007, the dollar really fell. It was at 47. Then we had some years here where I shouldn't say some years. We had 1 year. We had some years where it had fallen to 44, but actually went up to 53 cents in value. Right? So that was quite a jump. And the majority of that you can see here is because of the U.S. dollar index. Other countries' currencies were falling here. Price of Barron's, so you can see here they haven't raised the price since 2008. If you've ever looked at a Barron's lately, it's about half the size and has maybe half the number of pages. The 3-month Treasury jumped from 0.05% interest, right? So 1/20th of a percent per year in 2021 to 4.34%. And so now what we're going to do is we're going to jump to to adjusted. Now these are not adjusted, but we'll have the average, right? So the average yield over this past generation was 267 3 month, and it's currently at 434. So it's quite a big jump, right? 10-year note was at 388. The generational average was 413, so very close. AAA bonds still below, doing better, and then intermediates are also doing better than its average. Currently, and so what is the U.S. yield curve ratio? Well, it's the 10-year bond yield over the 3-month yield. And what we're looking for there is how is the underlying, not from a short-term perspective, from a longer-term perspective, how is infrastructure? How is this is not just an inventory, a temporary business cycle adjustment. How is the U.S. economy doing in general, right? And anytime this number, so like today, anything below 1 means that you're in a recession. Right? That's all it means. Nothing special. But when it goes above 4, 5, we're in trouble. So you can see here for many years we were just cruising along. Yep, you had some recession there in 1990. Came close for quite a while. Then all of a sudden, you had some bubbling up here. 2003 was quite a tough year. 2006, we went into a recession. And now here, these numbers, they look just like during the 30s and the Depression. So it was a modern day depression. Government doesn't really want to talk about it that way. We also had during COVID with that mass unemployment. It was sort of a depression. For the great majority of Americans, couldn't work from home, right? They were laid off. So if it wasn't for the stimulus packages that were made, there would have been some even further hardships. But like I said, we're back to normal today. The economy is doing okay, even though we're in a temporary cyclical downturn. The U.S. yield curve spread, this is what you've heard talk about times in the news. It's basically 10-year bond yield minus the 3-month Treasury bill. So the average good economy is at 1.45. So that it's humming along. Anything below that means that government is kind of constricting the economy in some ways. And right now, when you're negative, you're basically indicating it's going to be a recession of some sorts. So you can see here during COVID, it was quite tight government. Then during COVID, after COVID, they really lowered interest rates. Now, what happens when it goes above 146? Well, now you're juicing the economy. That's what happened here. Pretty much after 2008, the government really stimulated the economy. Right up to the downturn of 2008. We even had a year here of negative in 2006. The Fed was stepping on brakes. Here they were hitting the gas pedal again. Here they were stepping on brakes. And so in 1990, we had a small recession. Commodity Research Bureau, it's a collection of commodities. It has been in a cyclical downturn. And so what could be the reasons for this? It's certainly not the lack of interest in commodities. It's just the technology for locating oil, for making geological metals finds, become very, very good. Plus the machines, if you've ever taken a look at some of the Deeres, the Caterpillar machines out there, they just become gigantic. Right? So it takes much less manpower to move commodities around. Now, so it hit a trough of 73 some years ago. But now with inflation, who knows? Maybe we'll go above 150. Natural gas is slightly below average. Uh, the price of oil is way above average. Coal is triple the time average. So if you think that coal is going away anytime soon, I hate to tell you this, but now uranium was pretty much left for dead. It had its time, popularity, but recent activity, recent interest has sparked some more interest. So prices are now way above their average price. Moving along to Minneapolis real estate. If we look here, let's see, if we go back to 2013, prices were below average. You had some years here where prices were below average. Weren't that many. See if we go up here. Now in the 80s, we came from a period where housing was very undervalued. If 1994, 1999, 1998, they were basically a third they were today. This is in real dollars earned. So real estate is a place where you live. It's a fantastic visceral experience. A landlord can be a little more exuberant, can have a little parties, be a little noisier, and you can have more quietness as well. But in terms of investment, yeah, I don't think so. Things have to, and we'll see what happens with interest rates going up. But I have a feeling that there are a couple of underlying factors, right? So you have the number of houses which have been built, during the past decades has been way below average. Had lots of people that to the U.S. immigrants, and you've had wages that are pretty much stuck in 1970. So I'm not sure. We'll have to wait and see. I think because there's such a shortage of supply of real estate, I believe prices might not necessarily rise much from here. They will certainly not. And if you think real estate in Minneapolis is overpriced, then take a peek at prices in the U.S. Way overpriced against its average. And so here again, we had back in right after the 2008 financial disaster, 2011 priced at 73. So prices were way below average, almost. Let's see here, just out of curiosity, how higher are they today than at the trough there? So 122.7 over 73.3. Again, this is an average. They're 67% higher, and this is in real dollars. And compared to what they were, basically, they're pretty much, the lows in the U.S. were pretty consistent, whereas the lows in Minneapolis, they were much lower back in the 90s than they are today. So Minneapolis has become a booming town. The next asset class is farmland. And so it is way above standard deviation, very, very highly priced. And it has come from, it was very fashionable in the 70s. Then it became unfashionable, farm prices. That is definitely not sure what will happen there. No. Silver is way overvalued, as is gold. Copper is also overvalued vis-a-vis its historical average, as is iron ore. Steel is fairly evenly managed. Zinc is a little bit overvalued. Aluminum, here we have a bargain. It might be because people don't use aluminum anymore. Who knows? Right? Things go out of style. Corn, which was left for dead not too long ago. See here, back in okay, I am mistaken. I thought the low was 2, but it was 104. Well, it's almost 3 times as expensive as the low. 104 was back in 2005. Lumber, what do we have here? Priced at 154, average is 200. Had a very sharp drop from 402, which was way overvalued historically. So lumber kind of jumps around, doesn't go neatly as corn does. S&P 500 is overvalued, as is the NASDAQ. Dow Jones book value is twice its average. Earnings are also twice its average. Industrial average also twice as high, as is the utility average. Trannies also high. Silver stocks are lower. This is for many reasons, but I believe the biggest reason is that they water down their shares too much. They issue too many stocks. So the gold to XAU measures how the price of gold is doing vis-a-vis gold stocks. The higher the number, the worse they are, right? So gold stocks are doing better than they did in 2015, but nothing compared to what they were doing in the early 2000s vis-a-vis gold. Okay, this will be the end of part 2. Please let me know if you have any questions or any comments, and we will get back to you. Thank you.